Hello and welcome to our presentation titled Are Data Subjects Investors? This is an article forthcoming in the Berkeley Business Law Journal, but we think it has a lot of relevance for the audience here today. We're hoping to solicit feedback from you. We still have time to revise the article before it is published. And we also want to spark a discussion, not just on this paper, but on the topic in general. So with that, let's get started. Many of you have probably encountered something like this before. I encounter something like this frequently on a daily basis when I try to prove to websites that I am in fact human and not a bot. Now, I'm not sure if everybody realizes this, but when we click on these little squares, we're not just telling the computer that we're human, we're also helping to train the algorithm behind the scenes to learn to process visual information better. And of course, this is just one small way that we interact with a sea of data under the control of large data firms. And the question is, how should we think about our role in the way that these firms aggregate, process, and sell information with our cooperation? Now, the conventional view is that data subjects, such as when we use Gmail, for instance, have a consumer relationship with the data firm that provides services. Google provides Gmail as a service to me, and in exchange, I allow Google to collect information about the way I use Gmail. Here, the focus is on my consuming the service that Google provides me. There's not much of an emphasis on the data that Google collects from me. But in the past couple of years, there's been a growing movement to recognize the value of the information that Google collects from my activities. Proponents of this view, known as the data as labor view, seek to reclassify our relationship between us and data firms as a kind of labor provision. And as a result, proponents of this view seek to add greater protections for labor providers for these data firms and pave a way for getting better compensation for the data that we provide these firms. While we don't disacknowledge the value of the two views that I've outlined here, what we want to suggest is that there's a third way, maybe a better way of thinking about the relationship between data subjects and data firms. We want to call it data as investment. Here, the focus is on the data rather than the consumption of the services. Data subjects provide a capital investment of data to the data firm. And in exchange, we want to suggest data firms have an obligation to provide a kind of financial security to the data subjects. Now, of course, under the conventional view, it's not like people ignore the fact that firms collect data about us, and oftentimes we provide the data directly to the firms. And it's not like we don't recognize that the data can be valuable. But nevertheless, the conventional view tends to see the data that we provide to firms as something like manure abandoned on the side of the road 150 years ago. It has no value to us, and we simply abandon it. And the data firm is the one that does the work to collect our data, process the data, aggregate it, and make it valuable. And as a result, our main activity when we interact with the firms is with the consumption relationship that we have with them. And whatever the data firms do with our information, that's really neither here nor there for us, the consumer. It has no value to us. It's like manure that's being dropped from the horses that are pulling our carriage. It's the firms that come behind us, collect the data, process it, clean it, aggregate it, and make it valuable. It's to them that it's value, but not for us. Now, what the data as labor advocates want to suggest is that it's not like manure. Our data has a lot of value. Look at Facebook. Only 1% of its value gets paid out to laborers because the rest of the labor of collecting information, it gets for free from us. Think about how much of its value that Walmart pays in wages, 40%. It suggests that the labor that consumers are providing for these firms isn't being fairly compensated. And what data as labor advocates want to suggest is that we need more regulations in place to try to extract some of that value and redistribute it back to the workers, as in us, or at least provide some protections in the same way that the law provides employment protections. And what we want to add to the discussion is that data subjects might be better understood as investors. This isn't to say that they can't be considered workers or consumers, but there's something about being investors that's worth looking at deeper. Why do we care about this? Well, think about the kind of value that data subjects provide to these data firms. It can be thought of as a central mode of production within the modern economy. Data is the new oil is a slogan that we've heard many times before. And if we really want to try to grant data subjects certain rights, we might need to think about them as investors in addition to workers and consumers. Now, when we say that data subjects are better understood as investors, we're not necessarily saying that they are investors. The difference is what we call the distinction between objective and subjective understanding of what an investor is. Many people think about investors as entailing what we call a subjective aspect. Investors have this expectation of future profit. You are taking action today in order to benefit from that action in the future. And this involves a subjective mindset because you, with the intention of reaping a benefit in the future, are taking actions today. But that's different from what we call an objective condition of investors. What that means is that a third party can look at the relationship between data subjects and data firms and say that that relationship meets the characteristics that would satisfy us calling them investors, even if they don't recognize it themselves. Take, for instance, drivers for ride-sharing services like Uber or Lyft. As a result of recent legislation passed in California, these drivers are now, under the law, considered to be employees of these firms. Now, it doesn't really matter what the drivers actually think about themselves in relation to the firms. Many Uber drivers or Lyft drivers might see themselves as independent contractors. They might even call their relationship independent contractors in a contract that they sign with the firms. But regardless of what they think, what they actually are under the law is quite different. And it has implications for the kinds of protections that are provided for them under the law and the kinds of rights that they might have. In addition, we think that it's better to focus on the objective condition because the objective condition also includes a normative component. Because when we talk about data subjects being better understood as investors, it provides us a viewpoint for saying that they should be considered investors, even if they themselves do not, and even if they aren't quite treated as investors in society at the moment. So what do we mean when we say an investor of a firm? What we mean by investor is somebody who is justified in receiving a financial security from the firm in exchange for some asset contribution. Think about a shareholder, for instance, receives a financial security from the firm in exchange for financial capital. Debt holders, similar. They provide financial capital and they get a different set of rights. Option holders, though, think about employees with stock options. They also receive a financial security, and each of these different groups of people have different sets of rights. And this is what we mean by financial security, just a bundle of rights that can be characterized along 4 dimensions. And depending on the kind of rights that you'll have more or less cash flow rights or control rights or information rights or resale rights. And each dimension of what we call a financial security isn't just something that's fixed by contract. There's also law and practice that shapes the bundle of rights that an investor has. The key here is to understand that anybody who is justified in receiving a financial security from a firm can be considered an investor from our perspective. So why do we think that data subjects should be considered, or at least are better understood as investors? It's what we call the balance sheet impact argument. And to make our argument, we need to set some definitions first. So assets, liabilities, and equity, according to GAAP, are related to the kinds of economic benefits that something provides. An asset has a probable future economic benefit. A liability is something with probable future sacrifice of economic benefits, and equity is what's left over. And in addition to some of those basic definitions, we should also keep in mind some foundational rules for double entry bookkeeping. First, if there's a transaction, it must be reflected in the books for both parties. So if an investor makes an investment in the firm, the transaction must be reflected in the investor's books and in the firm's books. Not just that, for each firm's books, there's two sides of the ledger, and assets on one side must equal the liabilities plus equity on the other side. So here's an example of a firm that receives two separate $1 million investments at time one. Let's suppose that a firm receives $1 million bond investment and $1 million equity investment. At time one, what we see is that the firm's books reflects, in addition to the existing assets, now the $1 million investment in bonds and the $1 million investment in equity. We get $2 million in cash. But we got to balance that on the liability and equity side. So what we do is we book the bond as a liability. It's a $1 million bond that's going to mature at time two, whenever that time might be. In addition, we book the equity investment as an equity on the other side. And again, the goal is to make sure to balance the assets with the liabilities and equity. Now at time two, when the bond matures, what we notice is that there's an increase or a decrease in the assets of the firm. And this is represented by the delta box under the existing assets. At time two, after the time has passed as a result of the investment, we have had either an increase or a decrease in the assets of the firm. So that's reflected in the assets side. But we also have to reflect that on the liabilities and equity side. Now on the liability side, because there was a bond invested in us at time one, now we have accrued interest on the bond, and that's going to be a liability that we have to pay out to the investor. But there's probably also an equity portion. Hopefully, if there's an increase in the assets side, what we're going to see is retained earnings and an increase in the equity. So the folks who have invested the $1 million in equity now probably have a little bit more. But of course, if there was a decrease in the assets, then the folks in the equity side with the $1 million investment probably have a little less. But either way, what we're trying to show is that the assets must be balanced by the liabilities and equity on the other side of a firm's books. Basic accounting. But here's the important point that we want to make. Data is an asset too. It's an asset because it can be used to generate future economic benefits. Remember the definition that we provided of an asset a couple of slides ago. So what does that mean? Well, when companies acquire data from the data subjects, this transaction has to be reflected in the balance sheet of both the data firm and the data subject, us. But let's focus on the firm for now. And if the firm has to book the asset, our data, on its books, then there's got to be some kind of corresponding transaction that's recorded on the liability or equity side of the company's balance sheet. Well, if a firm collects data from us and as a result records an increase in the assets that it has, how should it record the liabilities or equities that correspond to the increase in asset? What we want to suggest is that it depends on the kind of data. There's some data that we call identity data. This is data that can be associated with the data subject that the subject can have some kind of claim to in the future. For instance, your name or your address. It's easily associated with you, the individual data subject, and you, based on law that we'll discuss later, have a claim to it in the future. But there's other data that's not necessarily specific to you. A lot of anonymized data or data about you or activity in general are not necessarily tied with you individually. You might not necessarily be able to maintain a claim to it in the future under existing regulations. So here's an example. You open an Amazon account and order a book at a certain time. Well, your name, your address, that's all what we call identity data. But the fact that somebody in your location ordered a particular book at a particular time, that's not necessarily something that's specifically tied to you. And our claim is that for data that's specifically tied to you, the firm should increase the liability It's kind of like a debt, something that it might have to return to you in the future. Other data that's not identity specific needs to be booked like an equity investment. So here's what it might look like. When there's an increase in data as a result of you interacting with the data firm, the data firm will need to book your data as an asset in two different ways. Some of the assets are going to be identity data, and some of the assets are going to be non-identity data. And of course, it has an existing algorithm and an existing database as well. And when it books the increase in assets as a result of the identity data that you provide and the non-identity data that it collects, it needs to book the corresponding asset in its liabilities or equity. So what we want to suggest is that the firm needs to book identity data related assets as a liability. That's kind of like a debt, like a bond, so to speak, that you might redeem at the future. But in addition, there's also non-identity data involved that needs to be booked as an equity investment. And why does that matter? Well, look at what happens at time 2. Because of the data that you provide, the firm is able to increase the assets because of the existing algorithm it has and the capabilities it has to process the data and to increase the value of the data. So what we're going to see is an increase in the value of the asset. But when we see the increase in the value of the asset, there needs to be a corresponding entry made on the books on the liabilities and equity side. Now, with respect to liabilities, you might want to think about assigning a value, what we call utility tokens, right? So something like access to the firm or the kind of services that you provide, that might be enough. That might be kind of like interest on the identity data that you provide, so to speak. But nevertheless, what we're going to do is to book that on the liability side. But there's going to be also some value associated with the increase from non-identity data, and that might turn out to be kind of an equity interest that each data subject has on the data that it provides, or at least that has consented to having the data firm collect from your activity. So here's an example. When Amazon acquires data from our activity, it's providing us access to the fulfillment network it has, and as a result, there might be something like a debt-like financial security associated with our identity-specific data and the kind of access that we have to Amazon's network that's quantified in some way associated with that kind of data. But in addition, all the value that's generated from our non-identity data, we need to somehow receive some kind of an equity-like security, because that's not necessarily tied with the identity data that we've provided for the firm. In either case, what we're trying to suggest is that there needs to be a corresponding increase in the liabilities and equity side for the increase in the assets that both our identity and our non-identity data provides. So of course, you might be thinking, well, that can't be right. Isn't the increase in the assets as a result of the data that Amazon collects, doesn't that just get booked as an increase in the equity held by the shareholders of the firm, not the data subjects? Well, if you want to try to take that stance, you have to think about who owns the data under Amazon's control in the first place. So what you really might think is that, isn't it the case that once Amazon collects information about me, that information belongs to Amazon rather than to me? Well, why might that be? Well, maybe it's because when I interact with Amazon, I have transferred whatever rights that I might have had to Amazon, and I've given up whatever rights that I had to the Amazon. And you might think that there's some data that's especially non-identity data that I don't even have rights to in the first place. That's all kind of Amazon's data, and as a result, there's nothing that needs to correspond in the books to something that I have to those increases in assets as either a liability or an equity. It can just simply be an increase in the value of the firm and thus increase the equity stake for the shareholders. So let's just not assume that Amazon owns our data or we own our data. Let's try to think about what it means to own anything in the first place. So think about a slightly different example. Let's suppose that you have some money that you want to benefit a charity with. So what you do is you set up a trust, you commit to funding it, and then you convey the trust to a third-party trustee who's going to watch over the trust. And you do it for the benefit of the charitable organization. Who's the owner of the trust? Is it the charitable organization? Is it you? Is it the trustee? It's hard to know. It's something analogous to asking who the owner of a corporation might be. So for some people, it might be simple and obvious, it's the shareholders, but for others, it's not. And it's because the idea of ownership doesn't really mean that much outside of the specific context that it's employed. Many people think that ownership just refers to a bundle of different rights. Cash flow, control, information, liquidity, some of these rights that define the contours of a financial security. There's a lot of different kinds of bundles associated with these rights. We can kind of unbundle them, divvy them up, dice them up, and distribute it however we think. So what we need to try to establish is not that somebody owns user data wholesale. It's a bundle. It can be divvied up and chopped up. And what we really need to think about is whether or not data subjects have enough of a bundle of rights in their data in the possession of the data firm to sufficiently claim that they have these important rights that would define what it means to have a financial security at all. That's really all we mean when we say that data subjects have some kind of ownership claim to the data that's under the possession of the data firm. So how do we know if data subjects have a sufficient set of ownership rights to the data under the firm's control? Well, let's look at the law. The law is going to define the ownership rights that we have to most things. And what we see is a trend that gives more and more rights to data subjects in ways that mirror the dimensions of a financial security that we've defined earlier. Think about the privacy regimes that give a variety of rights to information to data subjects. Think about the right to be forgotten in the EU. It's a way of providing data subjects control over the data, even though the data is already under the control of the data firm. And think about the right to opt out of the sale of your data. It's a kind of liquidity right that restricts the data firm's right to sell or alienate your data to somebody else. More and more along these dimensions, we're seeing data subjects be granted these robust rights that qualify, we think, as a sufficient set of rights that mirror what we define as a financial security in the slides before. But of course, we're not saying that the firm doesn't have any rights to the data either. The firm is doing a lot of work and provides a lot of value and makes our data a lot more valuable. And the firm does, through the user agreement, have rights to use your data for a variety of purposes. What we're merely suggesting is that just because a firm has the right to use our data, it doesn't mean that we've given up the right itself. It's kind of like me allowing a doctor access to my body. I'm not selling my body to the doctor has access to my body. In the same way, what we're suggesting is that data subjects have a sufficient set of rights to their data, even if they allow data firms the right to access and use, and even in some ways sell their data. It doesn't mean that the data subjects have given their data completely to the firm. They've merely provided access. And if it's the case that data subjects retain at least some rights to the data under the firm's control, we should expect when the firm books the increase in assets as a result of the data to have the corresponding liability and equity adjustments be reflected in some ways back to the data user. The data user can't have zero rights to the corresponding liabilities and equities on the firm's side if the data subjects have some kind of claim to the asset itself. Well, fine, we might think, but then doesn't that mean everybody's an investor in the firm that they interact with? Think about a customer at a coffee shop. Isn't the customer justified in receiving financial security from the coffee shop too if they just ask for it and have sufficient bargaining power to get it? Isn't it all a matter of contract? Doesn't it eliminate the saliency of the concept of an investor in the first place? While we don't want to deny the fact that a lot of the rights that you might have with respect to a firm that you have a contractual relationship with will be determined by the amount of bargaining power that you have, it's also important to recognize the rules that govern the relationship. And oftentimes, there are different kinds of rules that govern a particular relationship. One way to think about it is to distinguish between default and mandatory rules. A default rule is a rule that contractual parties can override through contract. A mandatory rule is a rule that you can't override. For instance, in Delaware, the board of directors can contract with the corporation so that the corporation waives certain fiduciary duties that are owed by the board of directors. Now, as a default, the board owes these fiduciary duties to the corporation and the shareholders, but they can waive it through contract. On the other hand, in California, you can't waive those duties on the board. What that means is that California employs a mandatory rule governing all of the fiduciary duties that the board owes to the corporation and the shareholders, but Delaware employs a mix of mandatory and default rules. Certain fiduciary duties are mandated, you can't override it through contract. Other fiduciary duties, you can. And our claim is that data subjects now are governed by a sufficiently robust set of mandatory rules that protect the rights that they have to their data. That makes it different from a consumer's relationship with a firm. Whereas a consumer with a firm might have great leeway of structuring their relationship through contract so as to waive whatever rights that they might have to a resource that they provide to a firm, data subjects can't even do that because the law already grants them certain sufficient rights that you can't contract out of. These are mandatory rules that govern the relationship between data subjects and the data firm in such a way that makes it sufficient for us to say that data subjects are investors and are different enough sufficiently from other types of stakeholders like consumers and suppliers. By now, we hope to have convinced you that it might be time to think hard about whether or not data subjects can be better understood as investors rather than mere consumers or labor providers. But even if you were convinced, you might still think this is a pipe dream. There's no way that this idea is feasible at all. And what we want to suggest is that necessarily. There have been other proposals in the past that seemed infeasible at the time, but now are a reality. Even think about the fact that now we can sell and trade and buy stocks digitally. Or look at the various sustainability indices that are in existence today. A lot of people thought they weren't feasible either. And if you look at kind of the nitty-gritty of it, there are technological challenges in the way. Most of the data firms already have the ability to implement something like a data investor type of framework. So it's possible to anonymize data collected even without user accounts, and financial regulation can keep up with the kinds of innovations in the financial market that might introduce a secondary market for user data, for instance, or in other ways protect the rights that data users have and to level the playing field so that they can negotiate for greater cash flow rights, control rights, information rights, liquidity rights. In other ways, it's possible. So if it's possible, we should take it seriously. Let's give more attention to the fact that it might be possible, in fact even better, to think about data subjects as investors in the data firm that provide data as capital rather than mere consumers or labor providers. Thank you.